Joins us, joint CEO with Anand Rathi Wealth. Feroze bhai, nice to have you back on ET Now. Thank you for joining us. Lots of block deals are happening in the market. What is your sense that block deal money which promoters are, where promoters are raising capital, is it coming back to equities? Is it going back into private capital? What's happening with so much of fundraising which is happening?
I think fundraising, which is happening at promoter level, Nikunj sir, good morning, is finding its way back into equity markets in the secondary market for sure. At least I think the answer lies in what proportions are going back into the capital markets. About 30 to 40% in my estimate, of course, guesstimate I would like to call it, goes back into capital markets. I think there's a lot of secondary deals which are happening. I think even in the unlisted space, one of our clients raised about from one of the FMCG giants almost about 1,000 crores, and he put back almost about 600-700 crores back into the capital market. So if I look at how our HNIs, who are running listed companies or unlisted companies over $1 billion, are doing, I would say at least 40-50% of that goes back and finds its way to the capital markets.
So the whole concept that promoters are selling, and that means that stocks will top out, money will be knocked out of equity market. This time it is changing. Promoters are selling some parts of their own businesses, but they are investing in other businesses. So this good old theory that lots of block deals and liquidity will be sucked out, we should not buy that argument.
Completely concur with you, Nikunj Saab. I think that argument, I think that's for old days. Of course, like earlier, it was very strongly frowned upon when the promoter was decreasing the stake. I personally think this time around, promoter decreasing the stake because we are one of the highest promoter holding. If you look at free floats in different sectors except banking and financial services, or Bank Nifty has about 86% free float. If you look at the least free float is 46% for IT, if I'm not wrong. And FMCG also have a free float, I'm speaking about Nifty FMCG index, is about 45-47%. So these are the two least free float, and pharma also has very little free float. So globally, if you compare, India's free floats across sectors is one of the least except banking. So I think it is gradually being seen positive. I think that's the natural direction. If 14.5 lakh crores has come into equity markets from FY21 from domestic institutions, 14.5 lakh crores in 50 months has come into after FY21. That has to get good quality paper. And I think if promoters don't dilute, we will be increasing valuations unreasonably, and that isn't sustainable.
All right. Hi, morning, Feroze. This is Shrishti also joining in. But Feroze, help us understand that how do you see the trend shaping up going ahead? Because the first half, and especially in the last 1 month, we have so many big deals happening. But can we expect more to see more of these in the second half as well?
I think yes. See, what happens is if I analyze when FIIs put in money, and I'm telling you after a lot of analytics done on this, FIIs have this tendency of buying on screen and selling on screen. So every rupee which comes in from FII or every rupee which goes out of from FIIs, it transmits into larger price movements. That's because they believe in buying in a screen, even if the stock moves 10% up, 15% up. But on the contrary, a domestic institution has a very, very specific price. They, of course, give a narrative of a very long-term story. But if I speak to the institutional brokers, they say, agar is stock ko 830 rupees mein kharidna hai, they will not even buy it at 832, even if they have to buy 10 lakh shares. So point I'm trying to make is, if the answer in the long term, will block deals increase? The answer is yes, because domestic institutions are the ones who are pumping in the money, and they're very price sensitive. FII is price inelastic. Probably on another day, I'll show you data to prove this hypothesis.
I was just going to come to that, Feroze, because what we understand is that these promoter blocks, more than 20% has been actually, absorbed by mutual funds. Is that correct?
Yeah, absolutely. And I think rightly so. Okay. If you look at, I might have mentioned this, but what disturbs me the most about Indian equity is the lower free float. The NSE 500 company, the lowest free float company is about 3,000 crores or 4,000 crores, not even $500 million free float. And that's the top 500 company. And ironically, I don't ever feel sad. I feel sad about being the 350th free float in the NSE 500, just having $1 billion of free float, or a little lower than $1 billion of free float. Anand Rathi Wealth is somewhere around 350th free float in NSE 500. So point I'm trying to make is, yes, going forward, block deals will increase. And I see it very positively. And in fact, one of the events I'd asked SEBI chairwoman, saying what will happen if there is so much money coming in and we have 140 crore people, and where will the paper come from? And she was reasonably positive that promoters will also sell and give good paper in the marketplace.
But what's the overall view then right now, Feroze, on the market? Does it seem like we will continue to hold out? I mean, we're just 2% shy from that all-time peak. But forget the index, at a larger participation level, do you think this kind of money inflow will continue?
Yes, Aisha madam, I personally very strongly believe that this will continue. In fact, if I have to flip it in one way, one thing which I've been talking about is cash market has become a derivative. Okay, derivative markets dictate where the cash markets are going, and this is one thing which I've been trying to check the hypothesis. You see, expiry days, Nifty moves as per the derivative market. On the contrary, derivative is called derivative because it derives its value from cash market. What am I trying to get to is derivative indicators. If I break total short-term market movements, I break it down into 4 components. One of them is, of course, derivative indicators. The second is liquidity. Third is fundamentals of the companies. And fourth is macroeconomic variable. In the chronological order of their importance for the time frame on a view, for the short-term view, like a week, 10 days, 15 days, derivative indicators are the sharpest predictive capability. So now let me tell you what they are actually currently implying. We have 36% long and short. Long is 36% in index futures for FII. Second, the synthetic futures, which I keep highlighting, which is one of the best barometers I've seen, for this month is now quoting at a premium of 95 rupees, which is close to the implied cost. Last week, it was significantly greater than an implied cost of 5.5% forward, which means that there is some degree of pullback in the subsequent expiry possible. That is indicating a neutral stance. So derivative markets are giving a little push upwards from an indicator standpoint, and liquidity, I think, is reasonably good as well.
The take on the markets, but Feroze, off late, select block deals, and especially where the promoters are actually selling their stake, in some companies that was seen to be happening where the stock valuation is actually stretched. That actually makes the investors nervous as well. Give us your sense, how should one read into that? You know what names I'm talking about, but is it really a red flag for the investors? What should be the reading?
In my opinion, I personally think it is certainly a red flag. It also depends on how have they behaved in the past. So because when you speak of a specific company, it's very easy to analyze what has been the behavior. Now, for example, if that is the kind of tendency at every peaks or valuations of their business, then I would be very circumspect of that specific block deal or an OFS. Because every time valuation goes up, if you're trying to dilute, then you're not here to make money for the retail guys. Now, for example, a couple of IPOs left a lot of money on the IPO side on the table relative to the unlisted space. Those are very, very good indicators. So I think the devil is in the detail when it comes to this specific hypothesis, whether are people selling out as promoters, just capitalizing on moving money from retail's pocket to their own, or they are actually genuinely wanting liquidity for more credible purposes.
Right. Okay. Feroze, great to have you on the show. Always good chatting with you. Always get great insights. Good speaking with you as always.